Welcome back, everyone. This is our third video in the one-on-one green technologies investor series. So in this specific conversation today, what we're going to do is we're going to step back. Okay. I want to step back from the company's specific announcements and I want to look at the copper market as a whole. So because the macro forces in this commodity right now, they are directly connected to the business case for what one-on-one does. So the global refined copper market is facing its most significantly structural supply deficit in recent memory, and secondary recovery is one of the very few levers that are available to close that gap. So the International Copper Study Group, which had previously forecast a surplus of for 2026, they revised its projection to a deficit of 150,000 tons. So JP Morgan's analysis puts the deficit at approximately 330,000 metric tons. So this is, that's a remarkable swing in institutional consensus in a very short period. So, Tony, from your vantage point, operating in this market, what is causing this supply side to deteriorate this sharply? And also, how quickly do you think that narrative has been priced into how people think about secondary copper?
We began adjusting our strategy in the second half of 2024, increasing copper processing as the supplier signals became clear. Primary mine production growth for 2026 is projected at less than 1%. Secondary or recovered copper is expected to grow at 6%. That difference is the space we operate in. From our directly experience in the market, industrial buyers in Asia Pacific are already experiencing supply tightness. We believe secondary copper as a supplier response is not yet fully understood by investors.
So the mine supply picture it's not about just one or two disruptions. Chilean production at Escondida contracted more than, I believe it was 16% year over year. So Collahuasi fell more than 12% Peruvian output. So that is Peruvian output specifically is now down over 11%. So force majeure has been declared at Grasberg in Indonesia. So my point is that these are not random events. So my question for you is, what is the underlying structural problem that is facing primary copper production right now? And why is it so difficult to solve with new capital investment?
The fundamental issue is ore grade depletion. Mines that produced copper at 1% grade previously are now operating at 0.5% or below. The same output requires twice or even more the material to be moved. The disruption at the Grasberg and elsewhere compound a picture that was already deteriorating structurally. A new greenfield mine requires copper price persistently above $20,000 per ton to justify development, and then about 16 to 20 years to reach production. That timeline cannot address a 2026 deficit. Recycling is one of the few supplier responses that can scale within a short period.
So one of the more counterintuitive features of this market is that visible exchange inventories across LME, SHFE, and COMEX have collectively surpassed 1 million tonnes for the first time since 2003. So on the surface, that looks like a pretty abundant supply, but more than 50% of these stocks are concentrated in US COMEX warehouses as a result of the front-loaded buying ahead of potential Section 232 tariffs. So how do you explain this inventory paradox to investors who see this big stockpile numbers and they assume, okay, look, this is the copper shortage narrative. So I guess my question is, what do you say when they assume the copper shortage narrative is overstated?
The aggregate inventory figure is not the relevant number. More than half of those stocks are concentrated in US complex warehouses, accumulated by buyers ahead of potential tariffs. The material is not accessible to the global market. Asia Pacific consumes more than half of the world refined copper, and it cannot access copper held in US warehouses. The supply situation for our region is considerable tight than the headline suggests. Our own sourcing is distributed across 3 regions, so we are not exposed to any single channel disruption.
Uh, so AI data center infrastructure, that alone is projected to require an additional 475,000 metric tons of copper by the end of 2026. So that's a 110,000 ton increase over the 2025 levels that are driven by this shift from air cooled to liquid cooled server architectures. So that is one demand vector among several. There's grid modernization, EV deployment, there's defense spending. So how does a secondary copper producer like One actually capture value from a demand surge that is happening primarily in developed markets? And also, on top of that, how close or how far is your product from those end users?
We supply copper alloy ingots and aluminum to industrial manufacturing in Asia Pacific. They produce the finished component that go into electronics, automotive, and construction applications. When demand from data centers or electronic vehicles increase, our customers increase orders, and that translates directly to our volume and pricing. On precious metals like gold, silver, and palladium are already enriched into our copper alloy ingots during the smelting process. Downstream partners currently perform the final refining, and we capture that value in our ingot pricing. Our intention is to bring that refining capability in-house over time. The Japan and Spain agreements are relevant here because imported e-waste from those markets contains significantly higher precious metal, concentration than domestic Philippine scrap.
So the argument for secondary copper as a strategic necessity. Okay, so that's compelling on paper, but translating a macro thesis into this financial performance that requires execution at the facility level, at the logistics level, as well as in customer relationships. So I want to ask, where is the biggest gap today between the scale of opportunity as described by the market data and the scale of what One is currently able to capture? And also on top of that, what closes that gap over, let's say, the next 2 years?
The primary constraint is capital. The infrastructure exists 300,000 tons per year design capacity, a licensed ceiling of 1 million tons. The equipment and the environmental permits. We are currently processing approximately 25,000 tons per year.
Wow.
Yeah, reaching 50% of design capacity requires about 120 to 150 million. The facility was designed to operate at this larger scale. Capital is what allows us to run it accordingly. On logistics, we expect to have a bulk carrier terminal operational in approximately 15 months, which would reduce shipping costs by approximately 5 million per 100,000 tons shipped. The foundation is in place.
Incredible. Well, listen, the conversation, I feel like this captures something incredibly important because the copper deficit is not a short, cycle story. The constraints on the mine supply they're structural. The demand drivers, those are long term, and the regulatory frameworks pushing the e-waste into recycling channels are only getting stricter. So one-on-one operates precisely at that intersection of all three of those trends currently. So I just want to thank all the viewers. Tony, thank you for your time, taking it out of your busy schedule. Really, this has been a very informative series. So thank you everyone for watching this 3-part series. And for additional information on top of that about our investor resources, please take some time, visit the company's investor relations page, or find one-on-one on NASDAQ under the ticker YDDL. All right. Take care, everyone. We'll see you on the next.
Yeah. Thank you.
Thank you.